Newsflash, insurance companies do not want to pay out claims. Insurance rates in the last several years have gone from semi-reasonable to completely outrageous. In many states, there have been not 10 or 20% increases, but up to almost 50% in a 5-year period. With all of these increases in premium, you want to make sure you don't fall trapped to some very, very obvious things that'll give the insurance company an out legally to not pay you. There are certain aspects of an insurance policy that if you don't have them in order, I's dotted, T's crossed, the insurance company will deny your claim. And the reality is, unless you do insurance for a living like myself, pretty much everybody does at least one of these big no-nos. These are things that only industry insiders and those who work in the insurance industry know anything about. So you're likely not to know even what you're messing up on. This is when ignorance is definitely not bliss, and having an expert, like myself, is going to be to your big advantage. Hey everybody, I am Max Marvelous. I have been licensed in insurance for almost 10 years now, 2014, and there have been so many times where I've seen the good, the bad, and the ugly of the industry. And I'm here to share the industry secrets, the insider secrets, that you only see from doing this for quite a bit of time like myself. I am here to help you save money on your insurance, make sure you understand it a little bit more, and then obviously make sure that claims are paid appropriately. That's what this video is all about. So without further ado, let's dive into the 7 things you should have in your policy to make sure that that insurance company pays out the claim. All right, so number 1 is the 80% rule for dwelling coverage. All right, so let's talk about Reckless Randy home policy. Here is Reckless Randy. He believes he's the omnipotent version of an insurance god, and he believes that he is so much smarter than his agent, he does not take advice from anybody. The reality is, he's a clown. That's why he has a gigantic red nose, because he believes that he is something that he is certainly not. Let's make believe that Reckless Randy has an incident where his home suffers a fire. And the reality is this is exactly how an insurance claims representative is going to handle this situation, especially with Reckless Randy. So let's say that as they're doing their investigation, they realize that the dwelling is valued at $500,000 if it were to be rebuilt today. This is what's called the should-be coverage, or the coverage that really Reckless Randy's agent recommended to them. So then let's take the 80% rule. The 80% rule is $400,000 for the dwelling, which pretty much states that you need to have 80% of the true value of the home, or the reality is you're likely not going to, you will not have claims paid out at 100%, which very, very much sucks. Okay, so here's what the actual coverage that Reckless Randy bought, because again, he's the man, in his mind at least. The dwelling for $350,000, so quite a bit less than the 80% rule. The damages from the fire ended up being $250,000, $250,000, and you'd think to yourself, well, you know, at $250,000, he has $350 in coverage. That means the insurance company should pay the full $250, right? I mean, makes logical sense, right? That's what Reckless Randy thought. He thought that he was going to get away with having less coverage. And the reality is that the company is not. The company is going to pay percentage-wise compared to the 80% rule. So that means the company is going to pay 87.5% because $350,000 is 87.5% of the 80% rule of the dwelling coverage of $400,000. And that turns into a dollar amount of $218,750. So that means Reckless Randy is going to be out in the cold and have to pay $31,000, $250 out of pocket. The whole reason I entered with this illustration is because you should not be like Reckless Randy. You don't want to be like Reckless Randy, period. With inflation higher than ever, this is your sign that you may need to increase or decrease your coverage. The reality is you want to make sure that you have adequate coverage, and this is your sign to call your agent and start the conversation. Because the reality is you don't want to have to pay, like Reckless Randy, over $30,000 because you didn't do your due diligence. All right, other structures is number 2. There are many structures that are detached from the home regarding insurance terminology. There are many things, many detached structures that fall into the insurance terminology. One that is mistaken quite often is a garage. If the garage is part of the house or built in, it does not fall under detached structures. It needs to go under the dwelling coverage we talked about just a moment ago. All right, let's talk about other structures. These include pretty much anything detached from the home. So if it is detached, not part of the home, then this is going to fall under that. Examples including a detached garage, a pool house, in-laws quarters or ADU, and a pole barn. There may be some other things that partake in other structures. If you have horses, maybe you have a horse stable. There are many other structures that can fall under this. These are just a few examples. And again, since inflation has really gone absolutely nuts the last several years, you want to make sure that you have adequate coverage for each of these. So if you have a pool and the pool is worth $50,000 and your other structures is only $25,000, you definitely want to make sure your other structures coverage is enough and adequate to pay for that loss. The next is going to be personal property and scheduled personal property. Most policies pay an absolute tiny amount for anything valuable. So if you have any one item that is valuable, and valuable pretty much means anything over $1,000 value, the reality is this: it probably needs to be under scheduled property. Because I don't know about you, but $1,000 used to be a lot when I was a lot younger, but today, not so much. So here are some examples of personal property: clothing, furniture, anything that does not have very much value to it. Now that doesn't mean if you buy a very nice sectional couch, it's not included. It's just there are very certain things that you need to schedule. And that would be these following scheduled property items: art, jewelry, firearms, coins, any collectibles, if you do sports cards or something of that nature, watches, of course, bicycles, musical instruments, and cameras. One other one that I did not put here was golf clubs. Sometimes people spend thousands upon thousands on their golf clubs. You definitely want to schedule that. Scheduling pretty much means it's going to be a line item on your insurance policy. So it's going to say, jewelry, diamond ring, value $5,000. And you can apply that to every single piece of scheduled property that we just talked about. The reality is this: if you have the $5,000 ring and it's not on scheduled property, the insurance company will go to what's called a sublimit, which I talked about previously. It's about $1,000 or so. They'll pay you the $1,000, and you'll be stuck having to pay the balance of $4,000 to replace the diamond ring. Not really the conversation you want to have with your wife, I'd imagine. Number 4 is what's called loss of use. If your house were to burn down completely, nothing left, this is where loss of use comes in. All right, so here's what loss of use really covers. It's expenses for temporary living arrangements. So if the house were to burn down, you're obviously going to have to live somewhere while they rebuild the house. So you think to yourself, in general, how long does it take to build a home? Depending upon how custom or basic the home is, usually between 12 and 24 months. So what's that mean? You got to figure out how much would it cost to rent a home in your neighborhood or your general area. You then, let's just make believe it costs $3,000 a month to rent a home in your neighborhood. 18 months is a pretty good middle range there to rebuild a, wouldn't say custom home, but a relatively okay home. So $3,000 a month for 18 months that you'll be living there is $54,000. The reality is you want to make sure that you have that as minimum coverage under loss of use. The reality is if your home were to burn down, that's a pretty bad situation to begin with. You don't want to leave yourself out in the cold and have to come out with out-of-pocket expenses when you're going through something that traumatic and unfortunate. Number 5 is sewer backup. The average U.S. infrastructure is very old, but specifically sewers are approximately, on average, 30 years old. And in many cities, it's way older than that. This is why sewer backup coverage is so important, especially for older homes. All right, so here's the jazz on sewer backup. Sewer backup, the reality is most policies have zero coverage. So if there were to be something that happened with the sewer, and it backed up into your home and caused damage, you would have no coverage. So the reality is, if you especially have an older home or older neighborhoods in general, this is a complete must. Damage from sewer occurs because of the following things. It's caused by roots, grease buildup, paper products not intended for flushing. The reality is that if you bought a home recently, you have no idea what the roots, grease buildup, or paper products that have been thrown down the drain. And if you've been there for a long time, things just happen over time. Even if you're as diligent as you could be with the grease, the reality is sometimes grease is going to make it in there. And roots, I mean, don't get me started on big trees. Big trees are beautiful to observe and have in your yard, but the reality is they absolutely cause mayhem when it comes to the sewer. So here's an example. If the sewer backs up, like after let's make believe you run the dishwasher, and next thing you know, you wake up the next morning, and unfortunately, as the dishwasher was giving all the junk to the sewer actually back up, and next thing you know, your whole entire kitchen flooring is destroyed. Again, most policies have no coverage, so that would mean home insurance is not going to pay you a cent. You're going to have to come out with that amount totally out of pocket. And the cost to replace the flooring in this example is $10,000. The reality is, if you don't have coverage, then you're going to have to take $10,000 out of your checking account and pay it, which is a lot of money. However, if you do have coverage, then you likely you are good to go here. So again, most policies don't have coverage. This is why sewer backup is so important for older homes specifically. All right, let's talk about flood, number 6. The reality is flood, generally speaking, on a normal home policy, which is about 99.9% of people have, there is zero coverage for flood. So that means if you're in an area that has floods relatively often or not relatively often, if there is flood, there is literally zero coverage. Your whole home could be destroyed not having flood coverage. What is a flood? How do they define a flood, though? Is any water that comes from outside the home. It's called an external event. So that's, again, not sewer backup, which we just touched on, but water from outside of the home, whether that be from rains, from a dam breaking, no matter what it is, it's water that comes from outside the home as opposed to the sewer, which is considered inside the home still. The reality you have to ask yourself is, are you in a flood-prone area? And if you are, even if you're not, you may consider a flood policy. The reality is there is really zero coverage on a normal home policy, and most people, in general, are very risk-adverse, so you may consider a flood policy. They're usually pretty good. They're usually priced pretty well, especially in areas where it doesn't flood very often. But again, if there were to be a flood, a flash flood for that matter, that is definitely not on the flood mapping, having no coverage is no bueno for anybody. Let's talk about earthquake, number 7. Earthquake is one of those things where, again, it is not covered on a normal home policy. And again, this goes to 99% of normal home policies are going to have zero coverage for earthquake. So again, the question you ask yourself, are you in a earthquake prone area? I was reading earlier that California has 90% of the country's earthquakes. But you want to know how many people actually have earthquake coverage in California? Only about 10%. So that means the other gigantic portion of the population, if an earthquake were to hit, there would be zero insurance coverage for their claim. So again, if you're in an earthquake-prone area, you may consider an earthquake policy. Again, not necessary for definitely non-earthquake-prone areas, but those 90% of people in California who do not have a earthquake policy, they are either self-insuring or hoping and praying for the best, which is not a very good risk management strategy. When you experience an insurance claim, it's pretty much the worst thing in the world. And if you're not going to be compensated for that loss because of non-due diligence on your part, that makes the injury have even more of an insult to it. Insult plus injury, not something anyone should deal with. So hopefully with these 7 ways and 7 tips and 7 things that you can now prepare for pretty much anything that comes your way, almost. Appreciate you guys watching. I will catch you on the flip side and have a magnificent rest of your day. Bye for now.